Welcome to today's episode, where we discuss India's very ambitious plan to decarbonize the nation, Iran's ridiculously low retail fuel prices, and China's pivot away from declining towards increasing oil production. Part 1. India's ambitious energy transition play. India recently surpassed China as the most populous country on Earth, with an estimated 1.4 billion people. A growing population paired with a rising middle class means more energy demand. Throw this together with ambitious emissions mandates from the central government, and it's also a big playing field for the energy transition, and with this battery metals, which play a huge role in producing clean energy. India is preparing a multi-billion-dollar subsidy scheme for companies manufacturing electricity grid batteries as part of its transition to clean energy. The proposal aims to accelerate India's shift away from coal and achieve Prime Minister Narendra Modi's target of building 500 gigawatts of renewable capacity by the end of the decade. The subsidy scheme would offer $2.6 billion from 2023 to 2030 for companies to establish manufacturing capacity for 50 gigawatt-hours worth of battery cells in the country. The plan is intended to reduce India's reliance on battery imports from China and ensure at least 90% of the value is generated domestically. The cost of battery storage is seen as an essential alternative to building new coal power plants. India has rolled out subsidy schemes to boost domestic manufacturing in strategic industries, and more subsidies are considered necessary to encourage battery manufacturing for the electricity grid. The government is also planning about $500 million in financing to cover the viability gap for companies investing in the sector. The market for grid batteries has enormous growth potential, but regulatory measures and market creation efforts are needed to support its development. Part 2. Iran's ridiculously cheap fuel prices. Iran has extremely cheap petrol due to heavy state subsidies. Prices start at only 3 cents per litre, a tiny fraction of prices in Western nations, such as the $1.10 paid at American pumps or the $1.88 in the UK. However, Ali Ziyar, deputy head of the National Iranian Oil Refining and Distribution Company, told local reporters this month that consumption had risen 20% since March to 124 million litres a day. But domestic refining capacity was capped at 107 million litres. This growing gap between supply and rising demand has led Iran to tap into its strategic reserves and import petrol for the first time in a decade. This move comes as Iran's hardline government under President Ebrahim Raisi is grappling with economic challenges due to US sanctions and is wary of potential public unrest. Despite the need to end the ultra-cheap petrol policy, raising prices is politically sensitive after past price hikes in 2019 led to violent protests. Violent revolts in response to increased fuel prices have also been seen in other countries this century, including Kenya earlier this year and Nigeria in 2012. Current fuel subsidies are a burden on the government, and while the situation is unsustainable, there is hesitation to make the necessary changes due to potential backlash. It puts the government under pressure to speed up development projects to increase refining capacity, although refining expansion projects can take years to be completed. Part 3. Chinese oil production reverses its decline. From 2015 to 2018, Chinese domestic oil production saw a sharp decline for 3 main reasons. Number 1. Depletion of large oil fields discovered in the 1950s and 1960s. Number 2. A focus on developing assets overseas in the 2000s and 2010s, especially in the likes of West Africa. And number 3. Lower spending on exploration and drilling after oil prices crashed from mid-2014 to early 2016 as OPEC flooded the market in an attempt to bankrupt the US shale industry. Then Beijing began to reprioritize energy security by shifting billions of dollars into developing domestic assets through state-owned giants, including Sinopec and CNPC. The motives can be argued, but these likely include an over-reliance on Western sources of energy, namely from the US and Europe, who in any future political or trade conflicts could use exports to China as powerful leverage. Controlling a larger share of the oil market is also a strong tool when negotiating foreign policy with the likes of Iran. From the low point in 2018 to the peak in 2023, China has added over 600,000 barrels per day of extra production, which is more crude than some OPEC plus nations generate daily. China now pumps roughly 4.3 million BD, rising to become the world's fifth largest oil producer behind the US, Saudi Arabia, Russia, and Canada, and just ahead of Iraq. This has complicated efforts by OPEC Plus to control the direction of oil prices as China continues to be a major source of demand and demand growth. Thanks for listening. You can follow our podcast here for updates on new episodes or subscribe to our written insights for free at commoditylabs.substack.com. Thanks for listening.